Okay, everyone, a very warm welcome this evening. We might kick off. We'll no doubt have a few more joining as we go through, but mindful of everyone's time. Firstly, thank you all very much for joining us this evening. We've got what we think is a fantastic session lined up, and hopefully you'll all get a lot out of it. We'll try and keep this evening as interactive as possible, and make sure that everyone has a really good chance to ask lots of questions and hopefully takes away as much as possible. Just a little bit of housekeeping for this evening. We do have three speakers. There will be opportunities to ask questions throughout. We have both the chat box and the Q&A box. We'll be monitoring both throughout the evening. So if anyone has any questions at all, feel free to pop them in either, and we'll try and make sure that all of the questions get answered throughout this evening. We will also have a bit of time at the end to follow up with any questions, and also obviously the opportunity as well to take this offline if anyone has anything more in depth that either we don't have time to or you don't want to cover on the live forum this evening. So before we get into the session and introduce our first speaker, a little bit of our background and I guess why we're all here this evening. So my name is Jared Brown. I'm a financial advisor with Global Financial Consultants, and just to give everyone a little bit of background on Global Financial Consultants before we get started. Originally started, funnily enough, in Australia back in 1997. And I say funnily enough because I'm both Australian and currently sitting in Western Australia at the moment, largely due to the COVID situation. But the business moved to Singapore in 2003 and is now one of the longest standing and non-institutionally aligned financial planning businesses in Asia. So something we're very proud of. We have a very diverse range of financial advisors in the business and cover quite a wide-ranging gamut of financial services. So from estate planning to investments to wealth protection, something we're very proud of and a really great team behind the business. Now, obviously, we're in a very interesting environment, and 2020 is potentially a year that some would rather forget, some would rather just hit reset and bring on 2021, and some are certainly making the most of. But I guess the question that's on a lot of people's mind is, what on earth do we do with our money? And so part of our job is always educating and empowering our clients and sort of supporters and friends and family to make smarter financial decisions, which is part of what brings us all together this evening. So we're going to hear from some great speakers tonight in terms of what we should be doing with our money, how do we take advantage of the situation that is unfolding, how do we structure things, and I guess just some of the general considerations for the year ahead. We're in a situation, we have a global health pandemic that has not been seen in years. We have politicians taking very different approaches, from limiting testing because that will ensure lower case numbers, to just remaining open because she'll be right and we can all just push forward. What the right approach is, I think time will tell. But for us as investors, it's a case of figuring out, how do we actually get through this? How do we structure our portfolios? And what are the opportunities we should be taking advantage of? So that's really what we're all here tonight. We call this the post-COVID wealth workout. We're not here to bore you to death or make everyone miserable with all the case numbers. I think that's been done to death by the media. But we very much want to move forward and work out, how do we structure our investments and what are the opportunities? So on that positive note, I'd like to introduce our first speaker, and that is Samir. Now, Samir is the co-founder of Bluefire AI, a capital markets intelligence firm. Now, it is one of the first predictive analytics risk firms in the industry, powered by AI for institutional investors across both equities and credit. Now, prior to Bluefire, Samir actually helped build one of the Asian businesses that is one of the world's largest algorithmic trading companies that was actually then went on to be listed on the New York Stock Exchange. He actually started with the Monetary Authority of Singapore as a macroeconomist. Don't hold that against him. It just means he's highly intelligent. He was actually educated all over the world at Brown University in the US, the Austin Center for Design, the Swiss Finance Institute, and Nanyang University in Singapore. So on that happy note, to share the importance of AI and what we should be doing with our money, I'll hand you over to Samir.
Thank you so much for that, Jared. Could you just give me a heads up if you can see my desktop and the slides? Yeah, fantastic. Hey, folks, as we get going with where exactly are the markets and the economy right now, I would like to start on a slightly somber note, and then we'll go on towards where the investment opportunities are and where do we really go now. What we're experiencing at this moment has no precedent for anybody that is living at this moment. This is once in 100 years situation, if you might. And just to highlight, what does that translate to from an economic perspective? At when we're talking about 2020, and we anticipate either a single hit on majority of countries or a double hit. This is the essential economic impact we're anticipating across the world. So you're seeing almost 14% decline in GDP in countries like Spain and France, who are the most affected, to at least 2 to 4% impact in countries like Indonesia, China, and Korea, which are the least impacted. What's noticeable and interesting to observe is for countries like India, Turkey, Czech Republic, and Spain, if there is a massive second wave, they're going to be affected quite strongly. That also comes across when we think about the unemployment in these countries. And essentially what you're staring at is, again, unprecedented, historically unemployment numbers that are going to explode by the end of this year, with Spain, United States, and United Kingdom leading the pack, not in a good way. To put this in historical context, on the left, you've got the share of all global economies. Yeah, we're talking 196 countries right now as recognized by the United Nations, back to whatever it was at that point of time. Since we have kept records in 1872, this is the largest percentage of countries that have ever been in recession at the same time. This is actually higher than the Depression era in 1928, 1930, when most of the world was under depression. Again, to compare it with the debt that we are seeing across both developed and emerging economies, we are reaching almost World War II levels of indebtedness in most of the economies that we talk about. For anyone who probably still can't visualize this, here is a global map of all the countries on which we've got data where the countries are in recession. So in short, from an economic perspective, this is a really challenging year for the entire world. And we need to be quite cognizant of this fact as we think about how should you manage your wealth and where do you go with it. Now, the difference with this kind of a pandemic-induced demand shock is that this is not just a hit to the economic activity, it's a breakdown in the operation of money and credit, which are two very fundamental facets of a capitalistic economy. These slides will probably be available to yourselves later on. I would encourage you to listen to the TED Talk from Ray Dalio, who has founded and runs the world's largest hedge fund. They manage about $160 billion in assets out of the US. What that translates to is when we look across top 3,400 global companies, yeah, these are the largest 3,400 listed global companies across the entire world, including US, China, and Japan. Almost 24% of these companies risk running out of cash by the end of this year. More importantly, in the US itself, what we are seeing is a lot of additional credit drawdowns from revolving credit facilities, which are rarely used. Majority of these facilities have not been used in the last 50 years. So this tells us how extreme is the need for cash for a lot of companies right now. That is simultaneously reflected in rising defaults, as well as a fast pace of downgrades, which leads to what we call in the markets falling angels, i.e. companies which used to be investment grade, really high quality, no issues with their balance sheets, or no issues with the financials, but they're starting to get downgraded because they can't do so well. Some household brand names that you'll recognize where this is playing out at the moment, Ford Motors has been downgraded to junk. Similarly, Macy's is another large US departmental chain store that's been downgraded to junk. And we're going to see more of this across the US and Europe as the year progresses. Now, what does that really translate to in terms of financial markets? That's the backdrop of the economy. What we are witnessing across the world is there is a big flight to safety. And coincident with that big flight to safety, as you know, gold is generally an asset that is considered relatively safe. Here I show the last 27 years, what has happened to the physical gold inventory, not financial manufacturing of a gold asset, but physical inventory. This reflects the amount of gold that is stored in COMEX in the US. That is the underlying physical gold that supports all futures and cash transactions in gold in the United States, that is about 3 times higher than it has ever been in the last 27 years. That's the level of fear that is around in the world at the moment. And if you look at all the asset class performance from the start of the year till right now, you see the US 10-year treasuries, which is one of the safest financial assets, outperforming literally everything else, yielding 14% from the start of the year, followed by gold, and then the German 10-year, which is another strong economy in terms of its performance. While I paint this picture around overall asset class returns, and I paint this picture around the economic situation, the stock market seems to have completely delinked from reality. Post the 30% drawdown that we saw in March, where stock markets collapsed quite dramatically, they have recovered from that 30% within 22 days. Here are all the times that the stock market has crashed since 1920s in the US by 30% or more. This is the quickest recovery by the stock market that has ever been witnessed. On the right-hand side, I show the stock market versus the bond market. And you can see the bond market is really not feeling like it's party time and not joining the stock market in the hoorah that we've been witnessing.
The very next day, the front page of the newspaper. Yeah.
Sorry, Deepak.
Don't put the.
All right. I guess that was not an intentional question interjection. I'll carry on. So moving forward, why is this really playing out? Are we really in a stock market bubble at the moment that is being driven by money on the sidelines? There is some evidence to suggest this. So on the left, what you're seeing is a broader ratio of the total market capitalization of all listed companies to GDP, and we're at the highest recorded in the last 45 years. At the same time, also when we look at retail activity with online brokers, is the maximum recorded since the last financial crisis. You can see it peaking since the start of 2020, and people obviously have been reading about stories on Robinhood users. We've been buying junk bonds or junk companies or bankrupt companies like Hertz. So a lot of unsophisticated retail money has definitely jumped in post the 30% crash and is to some extent responsible for the price movements we're seeing in equity markets. But that is not the whole story. We might also be in a bubble, asset price bubble, that is being powered by central banks. I provide a comparative to 1997, which was another major financial crisis with the Russian bond default and a large hedge fund called LTCM, Long-Term Capital Management, that blew up, that led to a big equity rally once the central bank stepped in with lowering rate cuts. Today, we see a very similar response from the Federal Reserve, Bank of Japan, and European Central Bank, between the three of them almost putting up a firewall against any asset price collapse of $20 trillion. What this is the major economies of the world deciding to socialize the entire financial and economic fallout of the pandemic across its entire country over the next few years, rather than taking one large shock in one shot. When we think about this, what does this really mean? When you look at markets in current situations, generally over the next 5 years or 10 years, you can expect to make pretty significant returns in stocks, bonds, and majority of portfolio constructed out of stocks and bonds. But be very careful for the next 12 months. The next 12 months could be anything between a negative 40% to a positive 50%. But within the next 5 years, you're probably looking at between 20 to 30% of return. Is this time really different? Is the bear market we're witnessing at the moment really different? This is a history of all US bull and bear markets since 1928. Let's fast forward to what's really played out as a response and why are we seeing this response from markets? Almost every country in the world has come through with a very large government support. Countries like Germany, Italy, Japan, and United Kingdom have focused most of their firepowers on loans, equity, and guarantees to protect jobs in their underlying economies. And that's really boosted asset prices. Countries like Australia and the United States are more focused on fiscal spending and actual spending. Now, it's important to analyze this in context to the chart on the right, because the chart on the right really tells us about how much more capacity do these countries have in terms of their borrowing capacity to support if there's a massive second wave or a massive third wave from COVID. That's really the uncertainty and the markets we're talking about. So countries like Sweden, Norway, China, US, Russia have a lot of borrowing capacity on the table and they can keep supporting their markets. Countries like Italy, Greece, Japan, and Argentina are kind of almost done. They're fully spent all the dry gunpowder that they had as a country to support. Where we are today is majority of German banks are imposing negative rates on corporate clients, and corporate bonds are not yielding much in Europe. When we try to put this in perspective, we've lost about 40 million American jobs to the pandemic. To put that number in a comparable, we had only created 24 million jobs in the last 10 years. We have a lot of countries that are getting into a distressed situation like Venezuela, Argentina, and Lebanon. And really, when we think about the entire world, we're seeing two engines drift in a very different directions. China seems to be doing far better than anybody else, not just on their economic activity, but also in terms of their forward-looking financial indicators on most parts of their financial markets. It looks extremely resilient with both strong pandemic control measures as well as onshore growth of economy and markets. The United States really depends on how bad is the double hit, the second wave. Going by what has played out over this weekend in states like Texas, California, and Florida, given the big push from the president himself for opening up maybe potentially a little too early, it's quite uncertain that the US would escape a large second wave. And we have to see how this plays out. Important thing to keep in mind, when companies lose revenues like this, you can look at the left chart where US corporate profits are plummeted in recent years. They get back to these kind of earnings within just a frame of 3 years. And stock markets usually tend to be forward-looking. A lot of the recent rally has also been pricing in the earnings growth if there is no second or third wave. So it's really a point to focus on. And this is a very interesting piece of analysis I did using mobility data from Google. So essentially everybody who uses an Android phone all over the world, you know how Google stores what's your home location, what's your work location. So this is a real-time tracking of in different countries, how many people have started moving between their homes and workplaces already. What you notice is at the worst through the first wave, almost every country had a 60 to 80% decline from their baseline activity. But right now, you already see countries like France, Germany, Russia, Vietnam, and Sweden in the positive territory, where in June, they're actually seeing more activity from workplace to home. And majority of countries are already at between 20 to 40% as close to baseline as possible. This is a very positive piece of information that we can see across the whole world. Now, as that happens, this year and the next 3 years, from a market's perspective, the devil is really in the dispersion, i.e. how are different asset classes going to perform? How are different financial market products going to perform? On the left, what you're seeing is all the different asset classes that you could be exposed to. Something like US mid caps or small caps have provided the most amount of dispersion and a larger breadth of returns compared to things like European government bonds. When we look at companies and countries from a default perspective and stress perspective, you can also see how different countries provide different opportunities. So Italy and United Kingdom look quite scary, while China, United States, and South Korea look relatively stable, even from the start of the crisis and how companies are handling their drop in demand for their products and services. The same scenario is also playing out for real estate across 4 countries where we've got indicators for retail, office real estate, industrial real estate, and other sectors. And similarly for different government bonds. You know, in a country like South Africa, you're starting to see a lot of sovereign default risk playing in. So what this really means is this year and the next 2 to 3 years is really time for active investing. You can't just buy indices and sit back you know, on your sofa and expect to make good returns like we've been making in the last 2 to 3 years. You have to be very careful. Who are you swimming with? You know, these are 2 quotes from one of my favorite investors. The risk comes from not knowing what you're doing, meaning you should be talking and clearly understanding what is it that you're exposed to in your portfolios, whether it is at a company level or an asset class level. And you also need to know who are you working with. And you know, that's the second quote. You never know who's swimming naked until the tide goes out. This is a time frame where you have to choose your partner for wealth management quite carefully, make prudent choices based on the risk you're willing to accept, and actively select the assets you want to be there in your portfolio. And you could come out of this in the next 2 to 3 years with very resilient returns. I'll stop here, Jared, and hand it back to you. I look forward to the questions from the audience at the end of the chat.
Thank you very much, Samir. Look, I think that's been very helpful. Some probably alarming statistics for some, with the level of indebtedness globally and the fact that so many countries are in recession. But I think you've highlighted some really, really valuable broad points for a lot of people. And one being, if you're only invested for the next 12 months, it's time for a serious reassessment, either with your financial planner or by yourself. But also that there are some great returns to be made for those that are paying attention over the next 3 to 5 years. So that's been very helpful. We will send through the link. So obviously everyone has a chance to have a look through the information you provided, and also check out that TED Talk from Ray Dalio. I think that'd be very helpful. So thank you very much. We'll move straight on to our next speaker, and that is Karim. Now, Karim is the ETF specialist with BlackRock. He's been involved in index, derivative ideas, and works with both institutional investors and financial advisors across the region. He sits on the Out and Allies Network EMEA committee, joining BlackRock in 2013. Prior to that, he was with Nomura and was an equity derivative strategist. So highly intelligent, coming up with trade ideas for all sorts of investors across the region. Holds a bachelor's with honors in economics from the American University of Beirut. He specialized in macroeconomics, game theory, and political science. So a very interesting combination given the current framework that we're operating in. He also holds a Master's of Science in Urban Economic Development from the University College of London. Now, in his free time, he volunteers with Opening Doors London, a subsidiary of Age UK that works with the elderly from the LGBTQ community. Also sits on the board of the Lebanon-based NGO focused on inclusive employment. So certainly makes the most of his time. He's always up for a good debate on macro matters, geopolitics, and also discussing running tips. So probably not a bad one, given gyms have been closed for such a long period of time. And I think everyone's been itching to get out. So on that note, Karim, I'll hand over to you to share your insights with our attendees this evening.
Thanks. I'll probably focus on market insights for this one as opposed to tips on Instagram athletes to follow, because there's lots of to see how people are going to get back to their subscriptions after lockdown. But to talk about some of the thoughts that we've had, a lot of the comments that were made by Samir, I really resonate with my thinking as well on the Covid-19 shock to the economy and how the ramifications of that shock are being seen across markets and also asset class implications. I would even agree with the comments about the need for selectivity in this environment and dispersion. We were seeing a lot of stock dispersion, even as the ETF specialist. And actually, I will share with you some thoughts on what this means for ETF investing in this environment, in an environment where you can't just buy the broad S&P 500 index and hope for the best. Because we have spent some significant amount of time thinking about this. But to start with the COVID shock, and it has been a shock like no other. It has no precedent, we have to admit. A lot of us have lived through the global financial crisis in 2008, but this time is very different. The shock is a recession by design. Governments chose, they didn't have much choice, but they chose to shut down economies to try and stop the spreading of the virus. And this led to an economic shock of great magnitude, bigger than the 2008 shock, and more sudden. However, the impact that it's having on markets is very different, and the way that we come out of this shock is very different. For starters, we think that we can get out of this shock a lot more quickly than we got out of the global financial crisis. So we can probably get back to the pre-COVID growth trend line by end of 2021. And because this is a pretty limited amount of time, it's only a year and a couple of months from now. And because the propagation of the economic shock, while great in magnitude, because the propagation we see as limited, we think this is quite possible. The view on getting back to the pre-COVID shock growth trend line is very contingent on most companies and the financial system making it to the other side, which is contingent on effectiveness of monetary and fiscal stimulus. So in other words, one caveat we're looking at, one signpost, is to make sure that bankruptcies remain in check. Not a lot of the world goes bankrupt, so that when things go back up and running, be it now, if the second wave is well managed, we're exiting lockdown, maybe this is it, maybe we slowly, gradually get back to normal and this is it, or be it after second wave, if the worst case scenario is that we get a second wave in autumn, we have to lock down again, and then we get out again. Eventually, we're going to get back to normal. And the key thing we're watching is, when we get back to normal, how much of the damage is permanent versus how much is temporary. Our base case is that the majority of the damage is temporary, meaning that as the economy reopens, companies will have no problem accessing cash flow and things will flow again. And as that happens, that's quite positive for the growth recovery. And on that basis, we see growth getting back to pre-shock trend line by end of 2021. So in this environment, we're actually cautiously positive on risk assets, but we do prefer credit. When we think about the asset class implications of this shock, and more importantly, asset class implications of the central bank stimulus and fiscal stimulus, I think this time is different than post-GFC, in that post-GFC, quantitative easing, loads of central bank stimulus, central bank rate cuts, the biggest way to trade this was simply to buy equities. It was the asset reflation trade. You buy equities, you buy the broad index, you're done, you're going to make money. This time around, it is a bit more complicated than that. For starters, we have the central bank stimulus very clearly coordinated with monetary stimulus, with fiscal stimulus. So we have this idea that central banks are actually directly financing government projects, which is all well and fine. It's actually what we've been calling for. You would have heard from some of our biggest thinkers at BlackRock, like Philip Hildebrand, who used to be the governor of the Swiss National Bank. You would have heard from him back in November. So even before the coronavirus crisis hit, you would have heard from him talking about this need for direct cooperation between monetary and fiscal authorities to get out of the next economic shock, whenever that may be and whatever it will be. And then that was in November. And then 2 months later, we were in the middle of coronavirus shock. And in fact, what he was talking about, which was all hypothetical, became real. And we did see this direct coordination between monetary and fiscal authorities. This is why it's different than post-GFC. This time, it's not just money and liquidity flowing into the system. It's money and liquidity earmarked for specific projects from governments, infrastructure spend, dealing with the virus, cash to Main Street, not just Wall Street. Remember, this time, it's the real Main Street problem that dragged down markets, and then markets rebounded. Whereas in 2008, it was a Wall Street problem that eventually hit Main Street. So all this to say, we're actually seeing asset class ramifications that are probably a bit different this time. Credit is more favored than equities. In equities, you have to get selective. And then government bonds may come under pressure. In the near term, we might see duration still do well. So you might see US treasuries and European bonds still do okay over the summer, a bit of safe haven trade. But down the line, 3 to 5 years down the line, duration is going to come under pressure because you have an amount of debt that is phenomenal that is coming online. You have supply of debt that is phenomenal, which is going to put pressure on prices. So we strongly prefer credit, and then equities, and then government debt. And the credit over equities preference is also one that you can think of in the context of the capital structure of a company. In an environment where we are in a recession, even though we think this recession, while big, will be able to recover from more quickly than the 2008 recession, it's still a recession. And in a recessionary environment, you do prefer to hold credit over equities because debt holders are ahead in priority from shareholders when it comes to capital structure and corporate cash flow. So this is the sort of top-down view on asset allocation view in the near term and long term that we are thinking about in this context. But if I zoom into the second half of the year, there's a few really interesting trends that are at play here. For starters, I think tactically speaking, while we're still focused on defensive exposures like healthcare, remember in healthcare, it's not just that pharma is doing well because of the pandemic, but also a lot of elective surgeries, and the whole industry built around elective surgeries and basically non-urgent medical issues have been postponed because of the pandemic and the lockdown. So as we ease from lockdown, you should expect pent-up demand for these hitting the tape in H2, which should benefit the whole industry built around them. So when I look at healthcare as a sector, I think in all its subcomponents, it's looking attractive in H2. Technology as well. Yes, NASDAQ is at all-time highs. Yes, the spread of NASDAQ to S&P, so technology stocks in the US, is also at all-time highs. Yes, the US rally is super concentrated in top tech stocks. But do you really want to bet against tech in an environment where virtual is above all? We're seeing it in all our industries. Even in our industry, the way I work on a research team, the way we publish our content has become a lot more live, on demand, virtual. Even before the coronavirus shock, we were doing a lot more webinars. Now we have to do webinars, they're the only option. And it's going to be a long time before we get back to normal. And guess what? 2 years, if it takes 2 years to get back to full normal travel, 2 years makes a habit. So it's hard to undo habits. So technology is going through a secular change that is leading to structural upside in demand, which we think, even though it looks really, really stretched in terms of the rally, could push it further. So healthcare technology are sectors we're looking at. Technology is also very cash rich, very resilient, high ROE, return on equity. So it's a quality sector, it has a quality tilt. Which brings me to the next point. We really like the quality factor. We've actually increased our overweight on the quality factor because quality does well in an earnings recession. Quality companies do well. They have strong balance sheet fundamentals and they can continue to grow earnings even as broad earnings go into decline across the board. But then, tactically speaking, alongside this continued defensive focus, we are looking at cyclical parts of the market. And here there's a few things that jump out to my mind. Value factor is super stretched and unloved. Nobody owns it. So we're starting to see demand come back into value. European equities. European equity, everybody loves to hate European equities. We've actually seen negative $30 billion of outflows from European equities across ETFs and mutual funds year to date. Huge. That's just in 2020. And we have had some major news in Europe over the past month. Macron and Merkel agreed on a deal for the next leg of the European Recovery Fund, which the European Commission has backed, 750 billion euros, which includes a mix of grants and loans. doesn't even matter what they finance and how much is grants versus how much is loans. The biggest news here is that the two major Eurozone members, Germany and France, are now both talking about debt mutualization. So this idea that you will have a single European bond issued that will help finance the next leg of spending that the European Union will use to help fight the virus and the recovery from the virus shock. This is huge because it means that we are one step closer to fiscal integration in Europe, which is much needed and sets Europe on the right track over the long term. So it does feel like we've crossed a milestone for Europe that deserves a lower risk premium from market pricing, which is supportive of European equities, which is supportive of European peripheral bonds like Italian sovereign debt and Spanish sovereign debt. And it's supportive of European credit, which the ECB is buying a lot of. They're buying a lot of European corporate bonds in their pandemic purchase program. So that's a direct price support for the European credit asset class. So we like everything under the sun when it comes to European assets, and they're unloved, they're underowned, which makes them even more attractive from a tactical perspective. So these are some thoughts about our tactical asset allocation views into the second half of the year. But what I wanted to do is also pick up on the conversation from Samir about selectivity and moving away from just buying the index. I think there's some really exciting trends happening here, even on the ETF side. At BlackRock, we think that selectivity, while necessary in this market, is both an alpha and an index story. We can do it in both. You have, as over the years, we've done a lot of research to break down alpha into three components. Pure alpha, this is the stuff that by doing research that breaks down alpha, we hope to free up capacity for portfolio managers, stock pickers specifically, to be able to generate pure alpha that benefits from dispersion in stocks, that is true idiosyncratic risk that selecting the right managers will help you achieve. Common alpha, which is basically alpha that is not super idiosyncratic. It has some commonality factor that you can see across a bunch of managers, but you don't exactly know why. So that's a question mark that deserves a bit more research. And then the third piece is factors. So alpha that is actually done by factor tilts and sector tilts and style and country tilts. So rather than alpha, it's actually just have a European overweight in your portfolio and you'll achieve it. Have a quality overweight like the factor view that I just mentioned. Have a healthcare overweight like the sector view that I just mentioned. And this for me is very exciting because it means that you can achieve the selectivity using ETFs like factor and sector ETFs, and additionally keep hunting for alpha with good managers to get your stock pickers right. And both together generate good returns in a portfolio in this environment where we're seeing stock dispersion on the rise. And then I wanted to leave you with a couple of stats about factor and sector ETFs that show that actually investors are already doing this. We have seen inflows into factor and sector ETFs really ramp up this year. In fact, throughout March and April, when volatility was high, inflows into sector ETFs outpaced inflows into broad equity exposures. In other words, we saw more inflows into exposures like tech and healthcare and quality on the factor side than we did into an S&P tracker or a Eurostoxx 50 tracker. And that's really interesting and unprecedented, actually. The second stat that I wanted to show is that we saw trading volumes on factor ETFs pick up by 65% year on year. So a huge amount of trading happening, not just inflows in the primary market of the ETF. A bit of basics here about the dynamic of an ETF, the primary market versus the secondary market. Not just inflows into the primary market that hit the primary market that lead to creation of ETF units, but also lots of trading in the secondary market of an ETF, which means trades that were changing hands that weren't big enough to tap into the primary market. So this is something that is, I think, another anecdotal stat that helps us understand that actually these tools are being used in this selectivity environment. And then a last comment before I close and hand back is we are seeing commodities hugely in focus this year for portfolio diversification. I'm not talking about oil, I'm talking about precious metals. Gold has had $34 billion of inflows across global gold ETPs this year. Silver is flat on the year, whereas gold is almost at all-time highs this week. It's flirting with all-time highs again this week. Silver is starting to pick up in demand, but it's lagging gold. Remember, silver has some industrial uses as well, so it's not a pure safe haven, but it is starting to come into focus. And actually, as we exit from lockdowns, it could actually start to play some catch up with gold prices. And then gold producers and equities. And here we've seen demand into both our gold producer ETF and iShares, and also into our gold producer flagship active fund managed in Eddie Hamro's world at BlackRock, where we're also seeing significant demand into that product. And gold producers are also lagging gold, but are starting to play catch up. So this theme was very gold focused at first. Some phenomenal numbers there, but it's starting to branch out into peripheral areas like silver and gold producers. And I'll stop here.
Wonderful, Karim. Thank you very much. I think you've given everyone a lot of food for thought, and yeah, very grateful for the presentation. I guess a couple of themes that have come across both Samir and your presentation, Karim, is the importance of selectivity throughout the second half, and I guess the course of the next 18 months. I think you've raised a lot of valid points, some of which will make complete sense to our attendees, some of which may have gone completely over their head. But I think it does just highlight, the complexity of the market and just how much there is to really pay attention to. And I think your point around highlighting the sort of resilience and quality of businesses in this environment is just so very important. And yeah, I do really like your point around, do you really want to bet against technology? I think this is, whether we like it or not, this is causing some changes in behavior, the way we all do business. And I think a lot of it is going to be here for good. So really, really appreciate that, Karim. Now, we've got quite a number of questions that have come through. They are sort of excellent questions, relatively broad. I will keep them to the end because they're not necessarily speaker specific. So we'll address those at the end. And I'll introduce our next speaker, just mindful of time. And that is Brendan Harper. Now, Brendan is with Friends Provident International, the head of technical services. So all of your complex questions, here is your man. He will answer them all, an expert on all things tax, structuring, and everything else. Now, he's been in the industry for over 26 years. He is the head of tax and technical support with Friends Provident International's wealth proposition, ranging in advice across the Isle of Man, Hong Kong, Singapore, and the UAE. So certainly a breadth of experience and knowledge. Prior to that, he was with Scottish Provident International and specialised in tax and trust planning. So certainly a great deal of expertise. Educated at the Queen's University of Belfast and the University of Ulster. He's a member of the UK Personal Finance Society, an associate of the Chartered Institute of Chartered Secretaries and Administrators, a chartered financial planner, and a qualified trust and estate practitioner. So certainly many qualifications, many post-nominals after the name, Brendan. So on that happy note, Brendan, I'll hand over to you to talk all things structuring and other things we need to be thinking about as expats in Singapore and abroad.
Okay, thank you, Jared. I'll just put up my screen first. Let me see if I can share that, and then you can tell me, panelists, with a quick thumbs up whether you can see my screen. That's perfect, and whether you can hear me. Pretty good as well. That's fantastic. So I can't guarantee you'll understand my accent. As you can tell, it's an Irish accent, but it has toned down over the years as I've lived abroad for quite a long time. So, well, thank you very much for the introduction, Jared. That saves about 5 minutes of the delegates' time anyway. And everyone, wherever you are in the world at the moment, I hope you're well, and I hope that you're enjoying some form of relaxation of the restrictions that we've all experienced in some form or other. As Jared said in his introduction, I spend a lot of my time dealing with customers and helping financial advisors like Jared to structure their investment programs and their retirement plans in such a way that they work for tax purposes and estate planning purposes, wherever they may end up retiring, whether that's back in their own country or in a third country. So I deal a lot with people who would term themselves as global expatriates, and people who move around borders and who invest across borders as well. So as you can imagine, over the last few months, I've had many discussions with lots of clients who have been impacted by the restrictions, particularly around the global travel restrictions and borders. So I just wanted to really share some of my thoughts with you today, using a few examples, and then also looking forward, what can you do to help you prepare your finances in a way that you protect yourself from future shocks. So, well, clearly the globally mobile people have been directly impacted by this, not only as a result of the sudden travel restrictions, but actually the speed at which borders went up. It really threw into question the whole idea of globalization, because it very quickly, even within single political entities like the European Union, federal countries like Australia, there were restrictions went up very quickly. And in fact, where I'm sat at the moment, in the Isle of Man, where we're part of the common travel area right across the European Union, our borders have been shut since the 20th of March. So we can't even travel to the United Kingdom and Ireland, so which I can see from my house, but I cannot travel. But that has also been our saving grace as well, in terms of our exposure to the virus. So expatriates have been impacted by this. And just to give you an idea, I thought I'd use a few examples of real clients of Friends Provident International that I've spoken to. The first one being a British expat who's living in Singapore, been there a long time on an employment pass, and we've had lots of discussions about his domicile in the past. And the reason why domicile is important to someone from the UK is because, unlike residence, it has a direct bearing on their exposure to inheritance tax, which is levied in a UK context, and it impacts on your worldwide estate if you're domiciled, regardless of where you live. And one way to shed that is to adopt this domicile of choice elsewhere. So we've been having conversations about his domicile of choice. When the travel restrictions and the lockdowns were introduced, he immediately got on a plane with his family and went back to the UK. And very in common with a lot of expatriates that I've spoken to and plus read their stories in the press, and I think Jared even may be one of these, that unlike unwilling to sit out a lockdown, possibly for months, in a small apartment in Singapore with very little outside space, was very much attracted to the fact that they had a larger property in the UK, and this could equally apply to an Australian, that had a large garden, had give them the ability to go for socially distanced walks in the countryside, and so the lockdown experience would have been a lot more pleasant for the individual. So the this client and many others have now found themselves in a position, as they are not Singapore PR, that they've effectively been locked out of Singapore, and because he is now present in the UK, that calls into question his UK tax resident status. He's living in Singapore. You've got a very low rate of taxation. We're not so fortunate in the UK or places like Australia. So I've had lots of conversations with people about their residency. And whilst governments like the UK and Australia, India as well being another example, have issued guidance to say that if you find yourself there against your will, that they have relaxed the position on residency. They're not so sympathetic if you have chosen to sit out the lockdown in their jurisdiction, and particularly in a UK context. My conversations with this customer have been around his domicile, and I can't really see how he can claim to have lost his domicile when the first time there's a crisis, he reaches for his home in the UK, which potentially brings him into the UK inheritance tax net on his worldwide assets. And I'll give you another example. Another one, and this was an Indian national. Actually worked his business is in the garment trade, so also was directly impacted by the economic impact of the restrictions, as his customers cancelled their supply orders, so immediately suffered a liquidity crisis as well as travel crisis. And in his particular instance, he has managed his days in and out of India so that he is not resident there. He has children at school in the UK, so he has a property there, and most of his contacts and his base, as he sees it, is in the UAE, in Dubai. And again, when the travel restrictions and lockdowns were introduced, suddenly the United Arab Emirates threw up its borders, closed them to anyone who wasn't an Emirati citizen, or if you were lucky enough to be on an employment pass and you were already in the country. So even if you had an employment pass and you happened to be outside the country, then you weren't allowed back in. So he's currently in the UK. And as he has no right of abode there, at some stage he's going to have to go somewhere else. And as he's a global citizen in his view, well, which country is his home? And I kind of think, well, your home is the place that can't turn you away if you turn up on their doorstep, and that must be India in his situation. So again, that could be that he becomes tax resident at some point during this time, and actually he may already be impacted by Indian residence rules, because they changed at the beginning of April this year, so that a new section 61A was introduced to the Income Tax Act that basically stated if you're a citizen of India and you generate more than 15 lakh rupees, which is about $15,000, so a very low threshold, per annum from Indian sources, and you're not liable to tax in any other territory by your residence or domicile, then you will be resident in India for tax purposes. So this threw a lot of Indian expatriates into a state of panic earlier in the year. But there were clarifications from the government that eased a lot of concerns, in that even if you live in a country that has no tax, like the United Arab Emirates, or a very low rate of tax like Singapore, that as long as you're a bona fide resident there, then this new 61A will not impact you. It's very much directed at the individual who considers himself to be nomadic from a fiscal or a tax perspective. So that could impact my customer. So why is that relevant? And using those two examples, I could apply that equally to Australian expatriates, to many European expatriates I've spoken to as well. Is that, looking forward, the whole idea of the expatriate existence is, got to be, is going to be directly impacted by this. And it really raises issues around where someone considers their true domicile and their residence to be. And if that is identified as the country where they were originally from, then it could impact their tax planning and their retirement planning. Likewise, if you have someone who has not actually adopted PR or set up a proper residence in a territory, that it will drive them towards regularizing their resident status abroad. And already in the Isle of Man, we've had reports this week that there are many more people expressing interest about coming to live in places like the Isle of Man, which maybe would have been less attractive because of their small size in the past. But now we have this stretch of water that has left us relatively untouched by the coronavirus outbreak, that people are considering health as part of their drivers as to where they may settle in the future. I think, look, listening to Samir and Kareem about on the economic side of it, we all know how much this is costing governments around the world to cope with this crisis. Inevitably, that will have to be paid for, and that will mean that taxes will rise, I think, in many jurisdictions, and enforcement will strengthen. So there will be more focus on exchange of information, less tolerance for people like my customer who treats himself as a fiscal nomad, and we've already seen the Indian government try to tackle that. I think that everyone will need to show that they have a proper tax base somewhere in the future, and then as people start to come out of the concerns around personal health, safety, liquidity, then they're going to look to the long term. And estate and succession planning. So getting your affairs in order have never been so important. And that is one thing that, we find that people ignore or put off as much as possible. That now that we know we're not as invincible as we thought we were, that will have much more of a focus. And some of the questions that, I would be asking a customer now is, at the very basic level, have you made a will? And is that will up to date? When was the last time you reviewed it? Have your circumstances changed in terms of, who you want to inherit your estate when you're no longer around? Which legal system do you want to govern the dispersion of your estate? And also, in addition to that, have you reviewed your retirement plans? I mentioned that jurisdiction may now be something that you're considering. Is health and safety going to be a bigger driver than sunshine and cost of living in the future? So does that mean then that you may end up in a country that has a higher tax rate than you anticipated? Which brings you on then to how have you structured your investments properly to cope with those plans? As people looked around for liquidity, it's like my customer that automatically saw his income reduced to zero overnight as a result of his business being directly impacted. Did he have easy access to his capital? Could he get hold of emergency capital? Was it protected by being based in a stable and well-regulated jurisdiction? So where you keep your money is very important, and you couldn't get a better place from a regulatory perspective than to retain your wealth in somewhere like Singapore, for example. And then in terms of structuring, have you structured your investment holdings in a way that if you do find yourself moving across borders, that it's portable? Have you considered the tax treatment of those investments, and is it the most efficient way to arrange your affairs to cope with that move? And then from an estate planning perspective, is it easy to transfer it to your chosen heirs without undergoing lengthy and costly legal processes? And if you happen to be from or live in a country that has an inheritance tax, have you planned for it? A lot of people haven't thought of this if they're living in places like UAE or Singapore, because the tax rates are low and very little in way of your wealth personally is taxed. But that is not the case in other jurisdictions. And so what I've seen is a lot more interest in our insurance wrapped or private placement life insurance solutions, and they can solve a lot of problems. So let me just sort of stop a little bit and explain what I mean by that. And it's helpful to look at if an investor holds a investment portfolio that's made up of the various asset classes, that they tend to, if they go to a platform or a wealth manager, they will hold those directly. They may be in custody, but legally, beneficially, they are treated as if they own the assets directly. And that applies to the tax position. So if you move to a country that has high tax rates on your income, that it levies tax on a worldwide basis, so it doesn't matter whether your money is offshore or onshore. Then that income and the dividends and the capital gains that arise from those assets will be directly taxable on you. You will be responsible for the reporting. You will have to do that in the accepted way that is done in your jurisdiction. If something happens to you and you have no planning in place, then probate process, which is the process you go through to establish who is entitled to those assets, would need to be done in possibly multiple jurisdictions. So what I mean by investment linked or private placement insurance is that you can set up an insurance arrangement where the benefits, I mean, obviously being from an insurance company, I'm speaking a lot at the moment to people about sickness insurance, pure life insurance that will pay out in the event of unforeseen circumstances. This is the same type of structure, but the benefits are not determined by death. They're determined by the value and the return on investments that you choose to hold within the structure. And when you do that, you don't own the assets directly. And that changes the character from a tax perspective of the investment returns. Now the income and the dividends and the capital gains are arising to the insurance company, and the investor is only required to report or to deal with the tax position of those benefits when he makes withdrawals or takes surrenders from the policy. So that creates a structure where at its essence, it means that if you move around jurisdictions, you can base all your assets in one place, and then you don't need to worry about the underlying tax position of you personally in that country until you decide to take money from the structure. So we call that in the trade inside tax-free inside build-up or gross roll-up or tax-free accumulation. And then what you'll find is that when you do take out the money, the insurance is usually treated much more favorably from a tax perspective and much more simply than holding your assets directly in multiple jurisdictions. And normally the headline rate of tax can be reduced or eliminated when you take your benefits. And then looking at succession planning at its most basic level, with an insurance contract, you can nominate beneficiaries. So that means that you are avoiding the need to go through lengthy and legal probate processes. And again, as a result of the COVID-19 crisis, what we've seen is that as public service, government services like the court service have closed down because they've been in lockdown, that actually if someone dies at the moment, it couldn't be a worse time to do so, because the probate that you need to be able to pass on assets to the next generation or to your heirs is taking a lot longer. It's taking on average in the UK at the moment up to 12 weeks longer than it would ordinarily take. And the standard time it would take would usually be between 3 and 6 months anyway. So the ability to nominate beneficiaries who can then claim an element of your wealth immediately to deal with that need for liquidity is a really valuable benefit. And that all adds up to simplification, really. So why is tax important? If you're a global expatriate, well, if you do end up in one of what I've chosen these 4 countries as, we have a lot of our customers in the global expatriate space in the places where we have a footprint will originate from one of these 4 countries, UK, Australia, India, and South Africa. And as you can see there on the left-hand column, that their headline rate of income tax is much, much higher than what you're used to experiencing in somewhere like Singapore. So if you end up back in those territories for retirement, you can get what I call re-entry shock from a tax perspective, because suddenly a lot more of your retirement income is going to go in taxation if you do no planning. And in the context of UK and South Africa, there is also estate duty or inheritance tax to deal with. And what we do is that we can minimize the impact of those by wrapping your usual investment programs in an insurance wrapper. Now, I won't go into detail, but I've given you a snapshot here of why that works. Well, at its essence, it's because you get tax-free accumulation. So you can continue to base your assets in Singapore and legitimately hold that structure up to the revenue authorities, and they won't tax it until you take money from it. And in the context of the UK, it is possible then to take withdrawals in retirement with no exposure to UK tax. From an Australian context, if you hold the asset for more than 10 years, then the benefits can emerge tax-free. So that's very complementary to someone who's also generating retirement income from a superannuation scheme or rental income, that they can add additional retirement income potentially tax-free. And in the context of India and South Africa, the headline rate of tax is reduced because the taxation, the gains are subject to capital gains tax rather than income tax, which is at a much more favorable higher rate than the highest income tax rate. And if you're thinking, well, okay, well, I'm going to regularize my affairs and stay in Singapore, I'm going to adopt a domicile there, and I'm not going to go to one of these high tax countries, then just be aware that there is what I call a hidden exposure to inheritance taxes potentially if you invest money cross-border. And in the context, for example, of a US equity portfolio or a UK equity portfolio, even if you have no other connections to the US or the UK, you could have an exposure indirectly to their inheritance taxes. And in the US, it's called estate tax. And the reason why we have that exposure for non-resident and domiciled people is because unlike a US citizen who can leave up to 11.58 million, and that's as a result of Mr. Trump actually raising the threshold, probably to suit himself. The US citizen can leave up to $11.58 million free of estate tax to their heirs, so very, very generous. And if they transfer to a US citizen spouse and don't use that exclusion amount because those transfers are tax-free, then the unused exclusion can be transferred to the surviving spouse. So very, very generous. But if you're for example, Singaporean living in Singapore with a US equity portfolio, you would be considered to be a non-resident alien with US assets. And as you can see there, I've highlighted it in red, that exclusion amount is a much less generous US $60,000 that you can leave tax-free to your heirs. In a UK context, we have a flat rate of 40% inheritance tax. If you have a UK stock portfolio, then you can leave up to 325,000 sterling free of tax to your heirs. In some instances, again, like the US position, transfers between spouses are exempt, and you get a double effect. So per couple, you can leave up to 650,000 sterling, so a bit more generous, but still something to consider. So, for example, if I use an example of someone who's very much typical of the global expatriate profile of our customer, Sanjay, a Singaporean resident, who's got PR, also an Indian citizen, and has right of abode in Australia. And like many expatriates who live in Australia, he intends to spend more time there in retirement, but also maintain regular visits to his country of birth. He's widowed, and there's a US share portfolio in his name worth $1.5 million US, and a UK share portfolio worth $1.5 million sterling. So without any planning, Sanjay faces in the US exclusion amount. He has an exclusion amount of $60,000. The remaining amount then is put through this absolute myriad of tax bans that they have in the US for estate duty, resulting in a $521,800 $521,800 estate tax exposure. So a third of the value of the portfolio would be taken in estate tax. And then likewise, with his UK portfolio, there would be a 340,000 sterling exposure. So on that portfolio, there's almost $1 million US dollars worth of inheritance taxes to consider. And it comes as quite of a shock to people. And I mentioned enforcement. At the moment, there's not a lot of enforcement around this area. I would predict that within 5 years, there will be a requirement to report inheritances where non-residents hold stocks and shares, and to ensure that the correct amount of estate duty is collected, just as we've seen with real estate in various jurisdictions. I would predict that that will expand to include liquid assets. And that can be easily solved by investing indirectly via a Singapore insurance wrapped arrangement. So you're not changing the investment portfolio. You can still hold your US and UK shares and other assets like ETFs and mutual funds. Then a nomination can be made in favor of Sanjay's children so that they receive the money seamlessly without any need to go through a probate system. And automatically, you've reduced the estate tax exposure to zero, saving $1 million US dollars, just by virtue of a very simple structure that takes away the legal and beneficial ownership from the individual and replaces it with the insurance policy. And the insurance policy is the capital that will pay out on death, not the liquidation of the investments. And also, if Sanjay decides to move around and spend more time in Australia or India, to the extent that he becomes actually tax resident, that it also will act as a tax shelter from an income tax perspective in those jurisdictions. So it's very much a structure that is used for the global expatriate. And that's me really finished now, just to say that, you know, as I've seen, a lot of people have been caught unaware. We tend to leave estate and tax planning until the last minute and ignore it. Please, you know, don't delay those plans, and make sure that you seek the help of an independent financial advisor who is used to working across jurisdictions so that they can give you the right structure. And I'll pass back now to Jared. Thank you.
Thank you very much, Brendan. Look, you've probably raised everyone's favourite topics, I think, there: tax, inheritance tax, estate planning, and probably raised a few alarm bells for many, I'm sure, with words like the sharing of information and no more tax nomad treatment. I can just travel the world and not pay tax anywhere. Certainly from the many conversations I've had with people in Singapore and abroad, those topics have certainly come up. So I think people need to pay attention. We can't just stick our head in the sand. But I think you've also raised some really valid points around health and various other factors becoming a lot more important in deciding where we're actually going to become residents in future. So I think this whole period in time is giving people a lot more food for thought in terms of what the future may look like. And certainly a lot more of our clients are looking to Australia to have a bit more space. And that also brings up another point you raised around that repatriation shock. We've certainly seen a lot of our clients who have made the move back to Australia wonder where half their salary is suddenly disappearing. So certainly a reality that's faced by many. So look, thank you very much. We'll dive straight into the questions. We do have quite a number to get through, and I am mindful of time. It's 7:15. So we'll get straight into it. Samira, I might start with yourself. I'll throw a couple your way to kick things off. So first and foremost, we're seeing money printed left, right and centre, particularly out of the Fed in the United States, but it's happening everywhere as various monetary authorities and governments try to prop up their economies. So two questions really. One is this going to cause inflation as governments try to, I guess, inflate their way out of debt? And could we also potentially see on the other side of the coin a demand shock that leads to deflation due to COVID?
Yeah, thanks, Jared. And both those questions are actually intertwined. So the first answer, is this leading to inflation? It really depends how you classify inflation. So if you look at some more progressive central banks, so both Australia and Canada, which are considered pretty much leading the pack in terms of how the central banks manage their economies, they include asset prices in their inflation calculation. And they're already seeing this as a massive asset price inflation shock. But however, if you're more, old school like the US and you separate your CPI and you don't have house prices or asset prices as part of that, you see no inflation whatsoever. But what I would say is this is more a question of how people live their own lives. I'm a big proponent of personalized inflation calculators, whether, and so when you're planning for your life for the next 20, 30 years, is what is it that you spend your money on? And that's essentially what you should be focused on. And from a pandemic perspective, I don't think all the disruptions to global supply chains is done yet. We should not take it for granted that whatever emergency lines have been set up at this moment are persistent and are going to tide us over this. So the supply chain disruptions are going to lead to some pretty massive shocks. Just as a point of trivia, so people in the audience get a handle around this. Singapore, before pandemic, we used to get our prawns from Vietnam. At this moment, all the prawns in Singapore come from Saudi Arabia. And that just blows my mind. That's how much, shock there is to the supply chains globally. And you could see some of the disruptions in supermarkets. Now, going to the second question, Jared, could you repeat that one again? The second about deflation, yeah?
Yeah.
Yeah. So the large challenge there is really a difference between financial assets and real assets. So anything which is a real asset and constantly generates actual value, which is being demanded from by the consumer, whether it is a corporate consumer or a individual consumer, is not going to encounter deflation. Yeah. So what I essentially mean by this is, when you think about over a longer term time frame, let's say 5 to 10 years, if our spending preferences don't change. This is a big debate going on in the world at the moment. So if you look at the US, we've just seen the highest savings rate the US has ever seen in the last 50 years. If this is just a pandemic inability to spend, then we're going to go back to the normal situation we're at and we're not going to go into deflation. However, if people change their spending habits permanently, i.e. we don't drink at pubs anymore, we don't buy the boats we used to buy, that's potentially going to lead to deflation for certain asset classes and certain components in the economy. There's a second challenge as well. As the governments across the world have gone out and given support to majority of the corporations, it also eliminates differentiation between different companies getting that support. So if all the companies get equal amount of support, you take away the entire incentive for taking risk. And then what happens is everybody sees a lost decade or two, just like Japan did in the 90s, because that's essentially what Japan did by subsidizing credit across the board for all Japanese companies, regardless of whether they were worthy of the credit or not. Whether we do it through quantitative easing or we do it through less stringent banking loans, is the same shit. So based off of that, what I would essentially say is the answer is not very clear right now, and people should look at their own spending baskets, whether it is from acquisition of assets or their lifestyles, to figure out how this is going to play out personally for them and not really depend on central bank inflation metrics.
Perfect. Thanks, man. Karim, one for yourself. Quite a sector-specific question. How do you see infrastructure playing out as an asset class over the remainder of 2020?
So looking at infrastructure, you can see that it's a big theme in the type of fiscal stimulus that's being brought online. For example, the US is already working a big infrastructure plan to top up onto the $1 trillion stimulus that the government has already launched in response to the COVID crisis. And then even in Europe, part of the European Recovery Plan, there is talks about what more can be done for infrastructure. Germany's infrastructure cycle, for example, was already getting quite old even before the crisis. So this could be the opportunity to start spending a bit more on these projects. So broadly speaking, we're quite constructive on the infrastructure sector. When I think about it as a listed equity sector, as opposed to completely in private markets, although there's merit to go into private markets for diversification versus public markets. But if I make a comment on the public listed sector for a second, I think there's a couple of things going on that are good for the infrastructure listed market. One is yield. It yields nearly 3%, which is attractive in an environment where rates are lower for longer and where a lot of companies that are on the receiving end of government bailouts are having to cut dividends. And the second is it's pretty defensive in terms of return profile. So it's well positioned in an environment of still elevated market volatility.
Perfect. Thank you, Karim. Samir, back to yourself. Q2 data, I think everyone knows and agrees, is going to be ugly. No matter what we really look at, consumer spending, new car sales, GDP data, it's all going to be pretty horrible or varying degrees of. Do you think that in, I guess, the second half of this year or Q3, that's going to lead to a correction in global equity markets?
It's a really challenging question, Jared. I would say under normal circumstances, yes. But at this moment, it's literally how willing are you to go against three central banks that are acting in absolute unison. You know, there's no relative difference between policy responses in the developed markets. So what I would say is, depending on the will and the amount of liquidity available across Eurozone, Britain, Japan, and US, we might actually not have a second quarter earnings correction. However, if you think about markets like Brazil, India, China, Russia, without that kind of support from their governments, and the governments not even having the capacity to provide this level of support, we could be staring at a pretty nasty correction. I would pretty much, even though we've seen big corrections in Brazil and India, I would still keep a big eye out. Similarly, other emerging markets in Eastern Europe, Turkey, South Africa, where governments just don't have the ability to step in this way.
Perfect. Thanks, Samir. Brendan, one for yourself, just so you don't feel left out in the corner there. We've had quite a number of questions, and I'll just try and wrap them all up into one, or I guess some sort of sub questions within the question, and it's largely around US equities. So we've had some people ask around their US shares, excuse me, that they've invested in via Singapore or Australian platforms. And also US equities that they've been awarded as part of their employment. So the two questions really are what exposure that creates as far as inheritance or estate taxes, and any tax they're liable for as far as dividends are concerned.
Okay, thanks for that, Jared. Yeah, yes, it's a very common question. So just taking back to first principles, US estate tax is determined either by your citizenship. So if you're a US citizen, it doesn't matter where you live in the world, you will have an exposure to worldwide or estate tax on your worldwide assets. But in return for that, you also are entitled to a very generous exclusion amount, 11.58 million US dollars, before you have to worry about US estate tax. For non-resident aliens, as they so charmingly describe everyone else in the world, the determination whether you have an estate tax liability is driven by whether you own US assets. So your non-US assets are not subject to estate tax, your US assets are. And then you need to look at, well, what is a US asset? And they're very obvious contenders. So if you own a property, so if you own a villa in Florida or an apartment in New York, then that is a US asset that will be subject to US estate tax. With shareholdings and equity holdings, it is whether if the company that you hold the shareholding in is a US registered company. Okay, so if it has a US base, so that brings in lots of companies like Microsoft and Apple, etc. That potentially they have a US situs that determines your US estate tax. And as I say, the exclusion amount is $60,000 US. Coming then to the point of what type of shareholdings that covers, it covers both your private shareholdings and shareholdings that you might hold in a listed company that's held via a platform. So because if you hold it through a platform, something like iFast, for example, which you might be familiar with if you live in Singapore, although iFast is the custodian, beneficially, you're the owner of those shares, okay? And likewise, if you work for a US employer and they grant you stock options, which you then exercise and you continue to hold the stock, they are a US asset for estate tax purposes. Now, I mentioned enforcement. It's probably more likely that enforcement would catch up with you if you own a shareholding in an employer in stock that you've had as a result of stock options from your employer, because they may be held in direct certificate form, or it may be an unlisted company, for example. Platforms is more an area where I see that there is probably less enforcement, because I would imagine what happens as it would happen in this part of the world. If you own listed stocks on a platform and you pass away, then your heirs will present probate to the platform. They will liquidate the shares and then pay you the money. Technically, that's not in compliance with US law, and I think that is going to catch up with people eventually. The other question was around dividends. US dividends are taxed at source before they're distributed from a US company, in common with a lot of other jurisdictions. And the headline dividend rate is 30%, unless you live in a territory that has a double tax treaty with the US. Australia being a good example, where the dividend rate would be reduced to a lower rate. I think it's 15% in the context of the double tax treaty between the US and Australia. So there's not really much you can do about that other than to live with that. But for the estate duty part of it, you can do something, and you can do something very simple in transferring the ownership of the shares to an entity, so that the arising benefits are not as a result of an individual transferring the assets on death. And two examples of that would be, for example, if you hold shares through the portfolio insurance wrapper, which I talked about, or indeed if you own the shares through a mutual fund. So a Singapore mutual fund that in turn invests into US equities. It's not the US equities that will pass on death, but the shares in the mutual fund, which is a non-US asset. So it's a very simple problem to deal with.
Perfect. Thanks, Brendan. Samir, just one final one for yourself, mindful of the time, and I know you have to duck off shortly. Quite a broad question, but I guess maybe if I can word it so that you can answer it in a couple of sound bites, perhaps. If I'm approaching retirement, or I'm already retired, and I'm looking at my portfolio at the moment, are there perhaps 2 or 3 things I should be sort of watching to remove or take action on in this current environment, given that I'm not going to be contributing any further?
Yeah, that's a great question. You know, again, going back to a very important slide that I walked through, because sometimes in our short-term perspective, we might miss how markets play out over longer time frames. As long as, even if you're retired or you're close to retirement, if you're not looking to use that money in the next 4 to 5 years, it's good to stay invested. Traditionally, you're going to make a lot more over that time frame where there might even be volatility within that space. And so recommended to stay invested. For the cash that you envision that you might need within the next 24 months, for that specific cash, what I would highly recommend is be selective in single securities that you expose yourself to. And from an asset class perspective, just play more defensive, stay in things like gold or things that actually give you decent cash flow. By that, I mean investment grade credits, companies that have strong balance sheets, that have very strong cash flows, and they are far away from any level of distress. In fact, to observe the quality of difference even in stock returns from this perspective for investment grade companies, if you looked at the top 25 percentile American companies that are close to defaulting versus 25% of American companies that have the most amount of cash flow, very healthy, the stock returns are almost 2.5 times in this last 3 to 4 months. So if you're exposing yourself broader to a higher quality, whether it is corporates with strong cash flows or countries with strong fiscal foundations like Switzerland, and then even within the next 18 to 24 months, you're in a pretty safe place. If you don't need to touch that cash over 5 years, stay invested. Even the sharpest of minds, no one's ever really beaten the market over longer time frames. It's exceptionally rare. So that's why that slide is very important. Whereas in a 1 year time frame, we could be down 40%, up 50%. Over a 5 year time frame, we're probably up about 30 to 40%.
Excellent. Thanks, Samir. Brendan, a couple of questions for yourself. So first and foremost, quite a specific one. So let's assume let's just create the hypothetical. I'm an Australian living in Singapore. I get my CPF and I lose my job. So I decide to hand in my PR. I get my CPF as cash while I'm still living in Singapore. Can I then put that into an insurance wrapper with the view that in 10 years' time that can potentially come out tax-free to me as an Australian tax resident?
Yes, I mean, assuming that you can take your whole CPF in one go, which I think you can take it as a lump sum. Yeah, actually, really topical, because I think it was only just this week or last week that the ATO in Australia published some guidance. I think that I read about that said that they're rethinking their whole definition of what a foreign pension is, the advantage of having a foreign pension and going back to Australia is that you have a 6-month window in which you can wind that pension up or transfer it to a super if you're within the the limits that you can do that to, and not bear any tax on it. Apparently, the ATO have said now that if you can take a pension from a foreign pension scheme in one lump sum, that they do not consider that to be a proper foreign pension arrangement. So it may actually be that not only is it a good idea to do that before you go back to Australia, but essential before you go back to Australia, because your CPF in future may not be treated as favorably from an Australian tax perspective. If you then have cash as a result of winding up that scheme, then investing it into a shelter that allows you then to accumulate the investment growth after you've gone back to Australia, and then gain access to it in the future in a tax efficient way is also a good idea. And as the options for Australians in terms of the old planning would have been to maybe put more into your super so that you could take retirement income tax free after age 60, that has now obviously been much diminished, because you have an overall maximum undeducted contribution that you can put in every year now. It used to be $1 million at one time, million Australian dollars. It's now 100,000 Australian dollars a year. Plus also you have a cap at the other end at retirement of only up to 1.6 million Australian dollars can be in this tax-free retirement fund after age 60, and anything else remains taxable. The insurance wrapper is a good complementary structure to that, because the contributions are unlimited, and all you need to do is wait for the 10-year period, and then once you pass that 10-year period, you can take out the money tax-free, and it's unlimited how much you can take out tax-free. And also worth pointing out that the 10-year period begins when you take out the investment structure, not when you return to Australia. So a lot of people may, if they do it early enough, may already have passed that 10-year point by the time they become resident in Australia.
Perfect. That's very helpful. I guess extending that a little bit further, we've for those Australians in the audience, and I guess for anyone with property in Australia particularly, we've seen a rather draconian change in the tax rules in Australia, where they've effectively removed the main residence exemption and will tax basically in full from purchase price anyone's capital gains on property for any property that's sold after next week, the 1st of July. So my question is, or the question from the audience rather is there any risk that there is a retrospective change to the tax rules around these insurance wrappers, whether it be in Australia, the UK, or anywhere else? Or do you think there'd be some sort of grandfathering?
Well, it's hard to say definitely which way that would go. You know, I've seen examples of where any changes in relation to the taxation of investments and insurance sometimes has been where you get grandfathering, which makes sense, because an insurance policy or a pension is a long-term retirement planning game, and you've got to have certainty over how that's going to be treated at the time that you take it out. So there is an element of grandfathering that is given to these arrangements. But I also see what they call not so much retrospection, but retroaction. So if changes are brought in, that it only applies to events that occur after that period of time. So they wouldn't go back and tax or collect tax on stuff that you've already accumulated whilst you've been in the structure. So probably retroaction, but you can never say never. You can only plan based on the rules as they stand at that point in time. Probably a more important point is can you unwind the structure easily if the tax rules change unfavorably? And that's why you need an insurance wrapper that is transparent from a charges perspective, so that it's easy for you to unwind it. It's a contract at the end of the day that is it can be cancelled by the policyholder at any time. So there's no requirement for us to hold on to their money. Compare that to someone with who goes to Australia with maybe an overseas trust that's being created, or an overseas pension that's now going to be caught by these new rules. It may well be that the rules have changed to make it less favorable from a tax perspective, but they can't actually unwind it because the trust rules have restrictions on them calling on the money. They can't revoke it. Or the pension arrangement may have a minimum retirement age that they can't access the benefits until they get to that age. That doesn't apply with an insurance wrapper.
Perfect. Thank you, Brendan. Another quite a specific question. So a British citizen in the UK currently looking to get a Portuguese passport, visa, right to stay in Portugal. How easy is that at the moment, bearing in mind Brexit and everything else that's going on?
Yeah, really topical. Well, I would say it's really easy at the moment to get residency there, but you need to hurry up. Because at the moment, until now, British citizens have been European Union citizens, so there's no restriction on them taking up residency in Portugal. Obviously, the UK have now come out of the European Union, and we have this 1-year transition period. that ends on the 31st of December 2020. And as I understand it, as part of the withdrawal agreement, that anyone who's a British citizen who is currently residing in Portugal, as at the 31st of December 2020, their residency status will be able to continue undisturbed after that point. So they will be grandfathered effectively into the new regime. After the 31st of December, unless the British request an extension to the withdrawal agreement, then they will be treated just like any other third country national. So it would be no different from a Singaporean national or an Australian wanting to go through the process of adopting residency in Portugal. Alternatively, you could be like the estimated 1/6 of the British population who has an Irish parent or grandparent, and you could try and apply for an Irish passport, and that would ensure that you've got continuing European Union residency rights after they withdraw.
Perfect. I think that's been very helpful. One final question for you, Brendan. As a British citizen with an American relative, am I liable, or is there a state liable, I guess, for inheritance or estate tax upon death?
So an American relative, it depends on the degree of relationship between them and which way the inheritance is going as well. If you have no connection to the US, but you want to leave assets to someone in the US, then as a if they are assuming they are non-US assets, then at the moment that there is no estate tax to worry about. So if it's based on the position of the person or the donor or the deceased, the person who is leaving the assets. So if you have a US citizen who receives money from a non-resident alien by way of inheritance, it's completely tax-free from a US perspective. Going the other way, if it's a US citizen who is leaving a state to a non-US citizen, then there could be a state tax for them to worry about. And that exclusion amount, if it's, the exclusion amount is in force. The only difference is that if the person leaving the estate is a US citizen and the person they're leaving it to happens to be their spouse, and they're a non-US citizen, there's no exemption, automatic spousal exemption. So you need to plan for that.
Brilliant. Well, hopefully that answers that one. Everyone, I'm mindful of the fact that it is 7:45, here in Western Australia and likewise in Singapore. So we might wrap it up there. If anyone has any other questions or anything that we haven't quite answered or our speakers haven't quite addressed, we will be following up. So you'll have our contact details to reach out. Happy to answer any other questions offline and even face-to-face, given the fact that the world is opening up again. But a huge thank you to Brendan and also Karim and Samir, our speakers this evening. I hope everyone's enjoyed it. I hope you've all got a lot out of it. And as I said, please do reach out with any other questions you have. But thank you all very much for giving up your Wednesday evening. Enjoy the rest of your week.
Thank you. Goodbye.